Fed officials say it's reasonable to begin the balance sheet reduction next month, and it's very possible Fed raise a key interest rate again. If Fed rate hike gradually, many investors want to know what would be the impact to the bond market. It's our pleasure to have an expert from Aberdeen Asset Management to talk about this today.
Well, as you say in your introductory comments, we are about to see the first balance sheet reduction from the US Federal Reserve and possibly from other central banks. And so there is great uncertainty in the markets as to how this will impact the markets. We know that when the Fed and other central banks started to increase the size of their balance sheets, then asset prices went very high. So the risk must be that when the Fed start to reduce the size of the balance sheet, that asset prices will fall. And so what we think is very important at Aberdeen at this stage in the monetary policy cycle is to be very diversified and to try and find asset classes that have a very low level of correlation with US Treasuries, US corporate bonds, US high yield, and US equities. Because surely, as the Fed start to sell, then the price of these assets will fall.
Which market do you recommend?
The best market that we can find right now to give investors the diversification they need is the Indian bond market. But the Indian bond market is very big, it's very liquid, and only 7% of this market is owned by foreigners. And because such a small percentage of the market is owned by foreigners, the correlation between Indian bonds and US Treasuries or German Bunds or Japanese government bonds is almost zero. Now, the other attraction of India is that the yield available is very high. The yield is almost 7%, and India is an investment grade country.
According to past experience, if Fed rate hike gradually, capital will always flow into US market. This will cause the collapse of emerging market, not only stock but also bond. Is this time different? I mean, the market response different this time?
Yes, we think it will be different this time.
Okay.
And that's because investors have been avoiding emerging markets for several years now. And we don't think it's fair to say that there is a bubble in emerging market assets. The bubble today is in the bond markets of the West. If the Fed start to raise rates and to start to reduce the size of their balance sheet, that is the bubble that's going to burst. And relatively, emerging markets should perform quite strongly on this occasion.
According to the India market, what's your viewpoint about the tension between China and India? Is it a good strategy to invest in India market on crisis?
Every country has border tensions and border issues, but that is not going to interrupt the reasons to buy Indian bonds. In addition to the very attractive yields and risk characteristics that I talked about, the fundamentals in India are improving very, very quickly. That is because of the reform process led by Prime Minister Modi. Historically, India used to be a high inflation, weak currency country. Now it is becoming a low inflation, strong currency country.
Yes, we have a similar feeling because according to our data in FundDJ, India market is around 6.5 to 7%. Compared to China, it's only 3.7%.
Correct.
So is this one of the reasons you suggest to invest in India market, or you have another insights?
Well, the yields are certainly very attractive. And remember that inflation in India is very low. The last print on CPI in India was just 1.5%. So if the 10-year government bond benchmark is yielding 6.5 today, that means in real terms, that is a 5% real yield. This is very, very high, one of the highest available, not just in developed markets, but in emerging markets today.
The last question.
Yes.
What's your personal investment portfolio?
Okay, that's the best question you can ask anybody. What are you doing with your own money? So what am I doing with my own money? Well, I have 10% of my pension fund invested in the Aberdeen Global Indian Bond Fund. So I would recommend you and all your viewers to also invest a substantial portion of your savings in this product.
Okay, Donna, thank you very much. Thank you. You are a professional and excellent suggestion to our audience.
Thank you very much indeed for your time.
Thank you.